Hello and welcome back. Let's get you up to speed on what's moving in the markets right now. U.S. equities closed higher yesterday across the board. The Nasdaq added 0.81%, the S&P 500 gained 0.65%, and the Dow was up a more modest 0.13%. But here's the thing, that data is from Tuesday's close. The system hasn't updated Wednesday's actual closing numbers yet, so what we're looking at right now is pre-market futures. And those futures are pointing higher. Nasdaq futures are up nearly 1%, S&P futures are up 0.58%, and Dow futures are basically flat. All of that suggests a positive tone going into the session. The clearest theme this morning is technology and growth. Tesla is up almost 4% in pre-market, and the QQQ, which tracks the Nasdaq 100, is up 1.31%. At the same time, the VIX, our fear gauge, is sitting at 14.63, which is low. That tells us risk appetite is healthy, and money is clearly rotating into growth-oriented tech names. On the flip side, the weakest area is energy and commodities. WTI crude is down 2.23%, Brent is down 2.11%, and spot gold is off about 1%. That combination is actually quite interesting. Commodities are selling off while tech is ripping higher. It looks like money is coming out of the commodity space and rotating into tech growth, almost like a seesaw. The market is not reading the commodity weakness as a demand recession signal. If anything, it might be seen as easing inflationary pressure. On the currency front, the dollar index is at 99.95, just below that key 100 level. The offshore yuan is firm at 6.7441. The 10-year Treasury yield is down 0.88% at 4.64. So put it all together, a weaker dollar, falling Treasury yields, and rising equity futures, that is a textbook risk-on setup. Theoretically, that should be a positive external backdrop for Asian markets. But here's where it gets a little tricky. The A-share market in China closed lower yesterday. The Shanghai Composite fell 0.5%, and the Chinext lost 0.45%. So you've got Asian capital playing defense while US pre-market money is playing offense. That's a divergence in sentiment. Whether that gap closes depends on how the A-share market opens today. If it opens higher and keeps climbing, the external optimism is getting through and the divergence is healing. But if it opens weak and fades, we need to watch out for a break in the risk appetite transmission chain, which could trigger a more sustained pullback. Now let's check our morning forecast against what's actually happening. The big picture call was right. AI compute and tech growth are leading, and the pre-market data confirms that. But there was one miss. The growth style in A-shares didn't deliver. The Chinext fell less than the Shanghai index, but growth names didn't see broad-based gains. The sentiment gap between A-shares and US markets was underestimated. And the biggest surprise today is that oil and gold are both falling while US tech futures remain strong. The market is completely ignoring the demand concerns embedded in that 2% drop in crude. In the face of tech stock momentum, that negative signal is just being dismissed. On the capital front, AI compute and tech growth is the strongest theme today, with about a 65% probability. Crypto-related assets are also firm, with Bitcoin edging higher and names like MSTR and ARKK posting solid gains. The weakest area is energy commodities. Oil is down more than 2%, gold is weak alongside it, and safe haven demand is cooling off. Let's talk about some individual names from our radar scan. The system flags the market as bullish with a risk budget of 0.8. A few names stand out. NBAS, the AI cloud infrastructure play, is up 34% over 2 days, but that move hasn't been independently verified, so we're watching but not chasing. POET, which works on silicon photonics, is holding above its 200-day moving average, and the technical picture is intact, so holders can stay put. AEHR is up 47% on the month, the catch-up trade is fully played out, and there are signs of insider selling and institutional distribution. That one, we'd suggest taking profits and trimming positions. NOK is also on the radar for exit or reduction, given the monthly decline, persistent institutional selling, and a lack of connection to the AI and semiconductor supply chain. So what's the play for tomorrow? The Shanghai Composite has a 55% probability of a stabilizing rebound today, with a range of 3,920 to 3,970. The drivers are firm U.S. pre-market futures, the dollar below 100, and a stable offshore yuan. The risk is if Wednesday's actual U.S. close comes in much weaker than the pre-market futures, that would directly pressure A-share sentiment. The AI compute sector has a 60% probability of continuing its strength over the next 2 sessions. The confirmation would be expanding volume and leading gains in A-share compute and semiconductor names. The offshore yuan is expected to trade weak and range-bound between 6.72 and 6.76. And spot gold is likely to consolidate with a downward bias between 4,400 and 4,450. Here's the bottom line on strategy. Stay long but keep position sizes controlled. The external risk appetite is strong, but there are 2 uncertainties. We don't have the actual U.S. closing data yet, and A-shares fell the day before. So participate in the tech growth trade, but don't chase and don't go heavy. If the A-share market opens higher this morning and compute and semiconductor volume expands at the same time, that's your green light to add. On the other hand, if crude breaks below $80 and U.S. futures weaken in tandem, stand down. And watch these invalidation signals. The VIX back above 16, the dollar index above 100.3, or the Shanghai Composite opening below 3,900. Our probability distribution for today is 35% up, 40% sideways, and 25% down. That's all for now. We'll be back with more updates shortly.